Alphabet and Amazon are two of the largest companies in the world, and they both have excellent prospects for the future. They both have excellent long-term trends. They operate in massive industries with large total addressable market opportunities and a long runway for growth. But which one of these two is the better stock to buy today? That's the question I'm going to answer in this video, comparing these two companies across several critical financial metrics, including revenue growth, returns on invested capital, and sharing with you my proprietary discounted cash flow valuation calculations for Amazon and Alphabet. I'll do all of that in this short video and answer which one I think is the better investment for long-term investors. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/partkev for the 10 best stocks to buy now. Let's start with the revenue growth and revenue increases over the previous decade. So Amazon and Alphabet have done a great job of increasing their business. Amazon started the previous decade with $89 billion in trailing 12-month revenue and increased that by more than 6x to over $650 billion over the most recent trailing 12-month period. Similarly, Alphabet increased its revenue from $66 billion up to $360 billion, or roughly 6x in that same amount of time. Amazon's compounded annual growth rate was better at 21.4% compared to 18% for Alphabet. That being said, Alphabet grew its revenues more profitably than Amazon did. And as I've said many times on this channel, it's easier to grow revenue if you sacrifice profit margins. Everyone can sell more of their product at a lower price. But if you want to generate greater profitability, you may have to sacrifice greater revenue growth. The name of the game is profits on the bottom line. It doesn't matter how many sales you make. What matters is how much returns to your pocket. And so overall, they've both done a great job, and it's a testament to the large market opportunities they operate inside. Right? Amazon operates inside several industries, most notably e-commerce and cloud services. Alphabet operates primarily in the advertising industry and more recently in cloud services as well. And it's got some it's got meaningful revenue generation in streaming content with YouTube, and also driverless car technology is potential for the longer term for Alphabet with its Waymo segment. So even though they've already grown their revenues by 6x in the previous decade, they have enough opportunity ahead in the markets they operate to grow their revenue meaningfully over the next decade and perhaps over the next 2 decades, because there's still a relatively small percentage of the overall markets they operate inside. So they can continue gaining market share inside of the markets, but also the markets they're operating inside are growing as well, right? So the advertising industry is growing by roughly 10% every year, and the e-commerce industry is growing by roughly similar, if not greater margins. Cloud services revenue is growing, and it's driven by artificial intelligence, which is inside the cloud services segments for each of these, which is expected to grow by another $1 trillion in revenue over the next decade. So by no means are these companies hitting their ceilings in terms of revenue growth. So one way I like to measure how lucrative these businesses have been, or how good these companies are at taking investor money, investing it into products and services that generate profits, is by looking at the return on investor capital. By the way, I'm getting all this data, these charts, from finchat.io. There's a link in my description for a discount, and you get a free 2-week trial. So the return on investor capital has increased for both of these companies. Let's start with Amazon, which has increased its return on investor capital by more than 2x in the previous decade, from 6% all the way up to 13.6%. That's an impressive trend, especially at the scale Amazon generates revenue, right? I shared with you almost $700 billion in trailing 12-month revenue at 13.6%. That's a lot of profit. It's more difficult to generate higher profit margins at larger scale. Amazon is doing that and improving. That's really attractive. Meanwhile, Alphabet has also improved their return on investor capital but not by as much because they were already starting at such a higher point, right? They started at 27.8% in 2016, which is already, almost 5 times as high as Amazon was at. But they still improved from 27.8% to 31% in the most recent update. 31% is a very good return on investor capital. And if I compare that with the company's weighted average cost of capital, which I'll share with you in a little bit, Alphabet has an almost 3-to-1 ratio in this metric, which is very, very good. So they're both excellent in this regard. Amazon is excellent because of the improvement and the number at scale. Alphabet is excellent for the actual number at 31%, which is really strong, much better than Amazon, but also they are improving in that regard. So now let's look at valuation and let's start backwards. The calculation, my intrinsic value, what do I think is a fair price or what do I think Amazon stock is worth today? That's the intrinsic value per share at $242. The current market price is $205. So it's undervalued according to my DCF valuation calculation. If you want videos that go through these calculations step by step, more detailed, I have them as member exclusive videos, and there are dozens and dozens and dozens of these, and you can get access to all of them at less than $5 a month. I think that's a steal. So the weighted average cost of capital I used for Amazon is 11.72%. And with that as the discount rate, I calculated the intrinsic value per share at $242. Now for Alphabet, the intrinsic value per share I calculated at $204. The current market price is $106. So this stock I also calculate as being undervalued. The weighted average cost of capital is 10% as I calculated for Alphabet, and I used the capital asset pricing model to incorporate into the weighted average cost of capital for each Amazon and Alphabet. It's part of my proprietary framework for evaluating publicly traded companies, publicly traded stocks. So Alphabet and Amazon look undervalued when I look at it on my DCF calculation. But I like to look at valuation in more than one perspective. And another way I like to look at it is the forward price to earnings ratio. And in this measurement, Alphabet is trading at a forward PE of 18, while Amazon is trading at a forward PE of 32.6. And again, I think both of these are undervalued according to these metrics, according to their prospects. I think they're both undervalued. In fact, I have both of these stocks rated as a buy, but not only that, I have both of these stocks rated as the top 9 stocks to buy. So they're on my list of the best 9 stocks to buy right now. But which one is the better one? Which one would I rather have if I can only have one? That would be Alphabet. It's close. I like both of them, as I've shared with you multiple times. But if I had to pick only one, I would pick Alphabet as the better stock to buy. And actually, I own Alphabet of these two. I own Alphabet. Amazon is on my list. I wouldn't be surprised if pretty soon I own Amazon stock as well. But right now, I own Alphabet, and I think it's the better stock to buy in comparison. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.